Hello everyone, in this video we will talk about the chapter 1 of book Financial Accounting. The name of the chapter is The Role of Accounting in Business. Chapter 1, The Role of Accounting in Business. What is a business? In general, a business is an organization in which the basic resources, which are the inputs such as material and labor, are assembled and processed to provide goods and services that are the outputs to the customers. The businesses come in all sizes, from a local coffee shop to the big ones like Apple Inc., General Motors, and Ford. A customer of a business is the individual or other businesses who purchase goods or service in exchange for money or other items of value. Now, if we talk of a church is not a business because those who receive its services are not obligated to pay for them. So, a church is a non-profit organization. Objective of a business. The main objective of any business is to maximize the profit by providing goods or service that meet customers' needs. What is a profit? A profit is a difference between the amount received from customers for goods and services provided and the amount paid for inputs used to provide goods and services. There are three types of business: manufacturing, merchandising, and service. Manufacturing business change basic input into products that are sold to individual customers. Few examples of manufacturing businesses are General Motors, Nike, Sony, etc. Merchandising businesses also sell products to customers. However, they do not make the products but purchase them from other businesses, such as the manufacturers. And some examples of manufacturing companies is Amazon, Walmart, Best Buy, etc. Service businesses provide service rather than the products to the customers. And the example is Google, Disney, Merrill Lynch, Marriott. The businesses can be formed in different ways. There are 4 main forms of business: partnership, proprietorship, corporation, and limited liability company. Let's talk about proprietorship first. A proprietorship is owned by one individual. Example of a proprietorship is the bagel shop, a laundromat, a repair shop, a barber shop in local areas. The proprietorship is simple to form. The owner of the proprietorship is fully responsible to all the creditors for the debts. Proprietorship is non-taxable, which means that the profits of the proprietorship are reported on owner's income tax return, which is 1040. The proprietorship ends with the death of the owner. One of the biggest disadvantages of proprietorship is that the financial resources available to business are limited to the individual owner's resources. Let's talk about the second form of business, which is a partnership. Now, As the business grows and the one person is unable to handle the business, usually the proprietorship converts in the partnership. So the partnership is owned by two or more individuals. Again, many of the local businesses that you see on the streets may be a proprietorship or a partnership, means that they are owned by one person or more than one person. If they are owned by more than one person, it's usually a partnership. Simple to form a partnership. Partners are fully and equally responsible legally to their creditors for their debts. Fully and equally. Partnership is non-taxable. It means that the profits of the partnership are reported on the partner's income tax return based on the percentage of partnership or based on the agreement. Partnership ends with the death of one partner. Disadvantage of forming a business as a partnership is that the financial resources are available to the business in a limited capacity. It's limited to the partner's resources. Let's talk about the third form of business, which is corporation. A corporation is organized under state or federal statutes as a separate legal entity. Ownership of a corporation is divided into shares of stock. Corporation issues stock to the individuals or other businesses, who then become the owners or stockholders of the corporation. The biggest advantage of a corporation is ability to obtain large amount of resources by issuing shares of stock to finance its operations. Examples of some corporations is Apple Inc., Ford, Google. Formation of a corporation is a complex process. Corporation has a limited legal liability. Limited legal liability, which means that the stockholder's liability is limited to the amount of invested in the company. A corporation is a taxable entity. It means that the corporation files its own tax return, which is called 1120. So the income of a corporation is double taxed. First, it's taxed on the corporate tax return, and second time when it flows to the stockholders on their individual tax return. Life of the corporation is limitless because it is a separate legal entity, regardless of the life of the individual owners. The last form of business is limited liability company, which is also called LLC in short form. LLC combines the attributes of partnership and corporation. It is organized as a corporation, but it can elect to be taxed as partnership. The owner's liability is limited to their investment in business. LLC can be formed moderately easily. Advantage is it has the ability to raise large amount of capital. LLC has a limited legal liability, meaning that the owner's liability is limited to the amount invested in the company. LLC is non-taxable. The income of the LLC is passed through to the owner's tax returns. LLC may terminate existence with the death of individual owner. Now here is a review of all forms of business. The first column states the forms of business: proprietorship, partnership, corporation, limited liability company. Let's look at the proprietorship. It's easy to form, it's simple. There is no limit means that the owner have the unlimited liability towards the creditors. It is non-taxable and it passes through the individual income tax return. There is a limitation on the life of entity and the access to capital is limited. Partnership is simple to form. It has unlimited liability to the creditors. Both or all the partners have unlimited liability to creditors for the debt. It is non-taxable and it passes through the tax returns of the partners. There is a limitation on the life of the entity and the access to capital is average. Corporation is complex to form. It has a limited liability to the creditors. It is a taxable entity. The income is taxed first on the corporate level and then on the individual level. There is no limitation on the life of the entity and the access to capital is extensive. Limited liability company is moderately formed. It has a limited liability towards the creditors. LLC is non-taxable. It means that the income passes through by election to the individual tax return. There is a limitation on the life of the entity and the access to capital is average. Now let's talk about how the businesses make money. The goal of a business is to make money by providing goods or services to customers. The profits are the excess of revenues from selling services or products over the cost of providing the services or products. So profits is equal to revenue minus cost. In order to increase the profits, the company must either increase the revenues, means the income from selling the products or services, or they must reduce the cost of producing those goods and services. Businesses try to maximize their profits by generating high revenues, low costs, and thus high profits. However, the business competitors are also trying to do the same thing. Thus, a business can only maximize its profits by gaining an advantage over its competitors. Here is a chart of the business stakeholders. A business stakeholder is a person or an entity that has an interest in the economic performance and well-being of a business. The first column of this chart shows the business stakeholders and then what interest they have in business, and then there are some examples. So let's go over them one by one. The first one is the capital market stakeholders. They provide major financing for the business, and the examples are banks, owners, shareholders, and creditors. Second category is product or service stakeholder. These are the buyers of the products and services and vendors to the business, like customers and suppliers. Government stakeholders. government stakeholders collect taxes and fees, and examples are federal, state, and local government. Internal stakeholders, individuals employed by the business, like employees and managers. So all these kind of stakeholders uh, are the person or the entity that have interest in the economic performance and well-being of the business. The capital market stakeholders expect to receive a return on their investment proportionate to the degree of risk they are taking. Since banks and the long-term creditors have first preference to the assets in case of the business fails, their risk is less than the one of the owners, thus their overall return is lower. The product or service market stakeholders include customers who purchase the business products and services, as well as the vendors who supply inputs to the business. The government stakeholders are the governments. Um, why they are interested in the economic performance? The better a business does, the more taxes a government can collect. The workers of the business are also taxed on their wages. And in contrast, if the workers are laid off or are unemployed and they file claims for unemployment compensation, which results in the financial burden to the government. So the government is also a stakeholder. Then, talking about the internal stakeholders, they are the individuals employed by the business. The managers are those individuals who the owners have authorized to operate the business, and the managers are primarily evaluated on the economic performance of the business. The managers of the business that perform poorly are often fired by the owners. Thus, the managers have an incentive to maximize the economic value of the business. Employees also provide services to the company they work for in exchange for pay. Thus, employees have an interest in the economic performance of the business because their jobs depend on it. Next, we are going to talk about the business activities. A business engages in three types of activities: financing activities, investing activities, and operating activities. We're going to talk about the financing activities first. So, what does financing activities means? It means in obtaining funds to begin and operate a business. Businesses seek financing through the use of capital markets. Financing may take the form of borrowing or issuing the shares of stock. When the businesses borrow money, it incurs a liability. A liability is a legal obligation to repay the amount borrowed according to the terms of borrowing agreement. When businesses borrow money from the vendor or a supplier, or when the businesses buy products on a credit basis from the vendor or a supplier, a liability is called accounts payable. Businesses may borrow money by issuing bonds. Repayment of the money with interest at specific times in future. The bond obligations are reported as bond payable and interest payable. Businesses may finance its operation by issuing shares of ownership in form of shares of stock. In case of corporation liquidations or bankruptcy, creditors must have the first claim on business assets. The second type of business activity is investing activity. Now, once the financing has been obtained, businesses uses investing activities to obtain necessary assets to start and operate the business. Businesses use the borrowed funds to purchase tangible assets like machinery, equipments, building, computers, trucks, etc. And they can also use the funds to buy intangible assets like patent rights. Businesses may use funds to pay expenses, uh, which are the operating expenses such as rent, insurance, etc. The third type of business activity is operating activity. Once the resources are acquired, the business starts its operations. Now, the main output of the operating activity, or the main target of the operating activity, is to earn revenues. Revenue is the increase in assets from selling the products or services. To earn revenue, a business incurs costs such as wages to the employees, rent, etc. Expenses. Expenses are the costs used to earn revenue. Net income. Net income results when the revenue exceeds expenses. Net loss. Net loss results when the expenses exceed the revenue. Let's talk about the role of accounting in business. First of all, what is accounting? Accounting can be defined as the information system that provides reports to stakeholders about the economic activities and condition of a business. It is a means by which business information is communicated to the stakeholders. Accounting is done by 1. Recording economic events affecting the business. 2. Summarizing the impact of those events on the business in financial reports called financial statements. The branch of accounting that is associated with preparing reports for users who are external to the business is termed as financial accounting. And there are two major roles of financial accounting. 1. To report the financial condition of business at a point in time. That's like a snapshot of the business. And 2. To report the changes in financial condition of the business over the period of time. It's like a video, the whole video of the business from beginning till the point in time. Accounting can also be used to guide management in making decisions about business. This branch of accounting is called managerial accounting. It's the internal accounting system. Let's talk about financial statements. Financial statements are prepared in order of income statement, retained earnings statement, balance sheet, and statement of cash flows. Preparing them in an order is important because the financial statements are integrated. Now, here there are the names of 4 most important financial statements that are prepared by the accountants. Number 1 is income statement. Number 2 is a retained earnings statement. Number 3 is a balance sheet. And number 4 is statement of cash flows. Let's also look at the objective of each of the statement. Income statement. Its objective is to report the change in financial condition. Retained earnings statements, the objective is to report the change in financial statement. Balance sheet, it reports the financial condition. statement of cash flow, it reports a change in financial condition. The first financial statement is income statement. Income statement is also known as the statement of operations, profit and loss statement, and statement of earnings. It is one of a company's main financial statements. The purpose of income statement is to report a summary of company's revenues, expenses, gains, losses, and the resulting net income or net loss that occurred during a year, a quarter, or other period of time. Some of the examples of the items appearing on net income are revenues. Revenues, which are the amounts earned through the sale of goods and or by providing services. Expenses. Expenses are the costs that are incurred in order to make those revenues. Net income, which is a result of subtracting the company's expenses and losses from the company's revenues and gains. Net income occurs when the revenue is greater than expenses. Net losses occur when the expenses are more than revenue. Matching concept. Matching concept means that all the expenses for the period are supposed to be matched against the revenues of the period. Let's look at the example of the income statement from JT Consulting Services. It is for a month ended December 31, 2007. So this income statement shows the monthly activities of the company. So in the month of December, the revenues from the fees income was 28,000. So this shows that it is a service company because they are collecting fees instead of making sales. Then there is a list of expenses that were incurred to make those revenues, like salary expense, utilities expense, supplies expense, rent expense, depreciation expense. All those expenses are deducted from the revenues and you get a net income. In this case, it's a net income because the number is positive. The revenues are greater than expenses. The second type of financial statement is retained earnings statement. Retained earnings statement. It means that the earnings are retained. Whatever earnings are retained since the beginning of the formation are listed on this retained earnings statement. It reports the changes in the financial condition due to changes in retained earnings during the period. What is retained earnings? Retained earning is the portion of corporation's net income that is retained in a business. A corporation may retain whole or a part of the net income to expand its business. It may pay portion or all of the net income to the shareholders in a form of dividends. Since the retained earning depend on net income, the time period covered by retained earnings statement is the same as time period of the income statement. Now here is an example of the retained earnings statement. It's for the year ended December 31, 2015. Now on December 31, 2015, the retained earnings at the beginning of the period, first what was the balance, the carryover balance from the previous years. Then you add this period's net income, or you reduce this period's net loss, and you subtract the dividends that are paid to the shareholders, and in the end you will get the retained earnings at the end. The third financial statement is balance sheet. Balance sheet is a list of all assets, liabilities, stockholders' equity as of a specific date. It reports the financial condition as a point in time as contrast to other financial statements that report changes in financial condition. Financial condition of a business as a point in time is measured by its total assets and claims right to those assets. So assets are equal to claims. Now those claims can be liabilities, or those claims can be stockholders' equity, or they can be a combination of liabilities and equity. So here you see a basic accounting equation. Assets equal liabilities plus stockholders' equity. A balance sheet is prepared using the framework of accounting equation. Total assets must always be equal to the total of liabilities and stockholders' equity. Now in this example of the balance sheet, you see that the assets are on the left side and liabilities and owner's equity are on the right side. And if you see the total of both sides is 75,600. They should always match. If they are not matching, it means that there is an error in the accounting. The last financial statement is statement of cash flows. It's a summary of the cash receipts and cash payments for a specific period of time. It reports a change in financial condition due to the changes in cash during the period. Any changes in cash must be related to one of the three business activities: operating, investing, and financing. So if you look at this example of a cash flow statement, which is for the period ending December 31, 2016, the cash flow from operations is listed first. Then there is another heading called cash flow of investing and cash flow from financing. So from operations, you see that the cash receipts from customers, which is the sales, cash paid for inventory, which is a negative 7,400, cash paid for wages, which is negative 53,000, and then a total net cash flow from operation is listed. And then you go into the next section, the investing section. Cash receipts from sale of property and equipment, which is a positive number. Cash paid for purchase of equipment is a negative number. And then you get to the net cash flow from investing. And the last section is cash flow from financing. In this example, it's a cash paid for loan repayment. So it's the in and out of cash in three different activities. And then the last line is net increase in cash, which is 17,372. Now this net increase in cash should be equal to the cash that is reported on the balance sheets. It's like a checkpoint to see if this number is matching to the cash on the balance sheet. If it's not matching, it means again that there is an error. Integrated financial statements. All the financial statements, the income statement, retained earnings statement, balance sheet, statement of cash flow, they are prepared in order. And preparing them in an order is important because the financial statements are integrated. Now let's see how they are integrated. Net income integrated to retained earnings. The net income or net loss appearing on the income statement also appear on the retained earnings statement as addition, which is the net income, or a subtraction, which is the net loss from the beginning retained earnings. So the net income from the income statement, it flows to the retained earnings statements. Now, how is the retained earnings statement integrated with the balance sheet? The retained earnings at the end of the period on the retained earnings statement, it appears on the balance sheet as a part of stockholders' equity. Remember that equation, assets equal liability plus stockholder equity. So in the balance sheet, the stockholder equity section includes the ending balance of the retained earnings statement. Now, the third star over here is balance sheet and cash flow statement. Let's see how they are integrated. The cash on the balance sheet also appears as the end of period cash on cash flow statement. This integration works as a checkpoint on whether the financial statements are prepared correctly. Accounting concepts. Accounting rules are called Generally Accepted Accounting Principles. The short form is GAAP, GAAP. These accounting rules determine proper content of financial statements. GAAP are necessary so that the financial conditions and financial data are compared across the companies and across time. GAAP determines the content of the financial statements. GAAP is established by Financial Accounting Standard Board, FASB in US, and it is established by relying on the following 8 accounting concepts: the business entity concept, cost concept, going concern concept, matching concept, objectivity concept, unit of measure concept, adequate disclosure concept, and accounting period concept. Let's talk a little bit about each of them. Business entity concept. A business entity could be an individual, a not-for-profit organization such as a church, or a for-profit company such as a real estate agency. The business entity concept applies accounting to a specific entity for which stakeholders need economic data. Once the entity is identified, the accountant can determine which economic data and activities should be analyzed, recorded, and summarized in the financial statements of the stakeholders. Cost concept. The cost concept determines the amount initially entered into the accounting records for purchases. The amount paid is the cost, not the amount that is asked for or that is offered during the negotiation. See, the only amount that affects the accounting records and financial statements should be recorded. Going concern concept. In most cases, the amount of time that the business will be able to continue its operations is not known, so as an assumption must be made. A business normally accepts to continue operating for an indefinite period of time. This is called going concern concept. The going concern concept affects the recording of transactions and thus affects the financial statements. If, however, there is a strong evidence that the business is planning to discontinue its operations, then the accounting record should show the values expected to be received. For example, the assets and the liabilities of the business in receivership or bankruptcy are valued from the quitting concern or liquidation point of view rather than from the going concern point of view. Matching concept. In accounting, revenues for the period are matched with the expenses incurred in generating the revenue. Under this matching concept, revenues are normally recorded at the time of the sale of the product or service. This recording of revenues is often referred to as revenue recognition. Again, under the matching concept, the revenues are normally recorded at the time of the sale of the product or service. This recording of the revenues is often referred to as revenue recognition. At the point of the sale price has been agreed upon, and the buyer acquires ownership of the product or acquires a service, and the seller has a legal claim against the buyer for payment. Objectivity concept. The objectivity concept requires that entries in the accounting records and the data reported on financial statements be based on objective evidence. If this concept is ignored, the confidence of the users of the financial statement cannot be maintained. For example, the evidence such as invoices and vouchers for purchases, bank statements for the amount of cash in the bank, and the physical counts of the supplies on hand support the accounting records. Such evidence is objective and verifiable. There could be cases where the accounting evidence is not visible or is not there. So in that case, the estimates or judgments can be used. Use of measure concept. In the United States, unit of measure is dollars. So on the statements, everything should be measured in US dollars. Adequate disclosure concept. Financial statements, including related footnotes and other disclosures, should contain all relevant data a reader needs to understand the financial condition and performance of a business. This is called adequate disclosure concept. The non-essential data should be excluded in order to avoid clutter. Accounting period concept. The process in which accounting data are recorded and summarized in financial statements is a period process. Data are recorded and the income statement, retained earnings statement, statement of cash flow are prepared for the period of time such as a month or a year. Balance sheet is then prepared as of the end of the period. After the accounting process is completed for one period, a new period begins and the accounting process is repeated for the new period. This process is based on accounting period process. Here is a list of the glossary of the terms that were used in Chapter 1. As an accounting student, these terms should be familiar to you and you should know the meaning of these terms. So let's review. Accounts payable. A liability created when a business borrows from a vendor or a supplier. Accounts receivable. Right to payments from the customers. Accounting. An information system that provides reports to stakeholders about the economic activities and condition of a business. Accounting equation: assets equal liabilities plus stockholders' equity. Accounting period concept: a concept of accounting in which accounting data are recorded and summarized in period process. Adequate disclosure concept: a concept of accounting that requires the financial statements include all relevant data a reader needs to understand the financial condition and performance of business. Assets: the resources owned by a business. Balance sheet: a list of assets, liabilities, and stockholders' equity as of a specific date, usually at the close of the last day of the month or a year. Bonds payable: a type of a long-term debt financing with a face amount that is due in a future with interest that is normally paid semi-annually. Business: an organization in which basic resources, that are the inputs, such as materials and labor, are assembled and processed to provide goods and services, which are the outputs, to the customers. Business entity concept: a concept of accounting that limits the economic data in the accounting system to data related directly to the activities of specific business or entity. Business stakeholder: a person or an entity who has interest in economic performance of a business. Business strategy: an integrated set of plans and actions designed to enable the business to gain an advantage over its competitors and in doing so maximize its profits. Capital stock: type of stock a corporation may issue. Combination strategy: a business strategy that includes elements of both low cost and differentiation strategies. Common stock: the basic type of stock issued by a corporation to the stockholders. Corporation: a business organized under state and federal statutes as a separate legal entity. Cost concept: a concept of accounting that determines the amount initially entered into the accounting records for purchases. Differentiation strategy: a business strategy in which a business designs or produces products or services that possess unique attributes or characteristics for which customers are willing to pay a premium price. Dividends: distributions of earnings of a corporation to stockholders. Expenses: costs used to earn revenues. Financial Accounting Standards Board (FASB), the authoritative body that has a primary responsibility for developing accounting principles. Financial statements: financial reports that summarize the effect of events on a business. Financing activities: business activities that involve obtaining funds to begin and operate a business. Generally Accepted Accounting Principles (GAAP), rules for how financial statements should be prepared. Going concern concept: a concept of accounting that assumes a business will continue operating for an indefinite period of time. Gross profit: sales less the cost of sales. Horizontal analysis: a method of analyzing financial performance that computes percentage increases and decreases in related items in comparative financial statements. Income statement: A summary of revenue and expenses for a specific period of time, such as a month or a year. Intangible assets. Assets that are rights to future benefits, such as patents or copyright rights. Interest payable. A liability to pay interest on a due date. Investing activities. Business activities that involve obtaining necessary resources to start and operate a business. Liabilities. The rights of the creditors that represent a legal obligation to repay an amount borrowed according to the terms of borrowing agreement. Low cost strategy. A business strategy in which a business designs and produces products of acceptable quality at the cost lower than its competitors. Manufacturing. A type of business that changes basic inputs into products that are sold to individual customers or other businesses. Matching concept. A concept of accounting in which expenses are matched with the revenue generated during the period by those expenses. Merchandising, a type of business that purchases products from other businesses and sells them to customers. Net income, excess of revenues over expenses. Net loss, excess of expenses over revenues. Note payable, a type of short-term or long-term financing that requires payment of the amount borrowed plus interest. Objectivity concept, a concept of accounting that requires accounting records and the data reported in financial statements be based on objective evidence. Operating activities, business activities that involve using a business resources to implement its business strategy. Owner's equity, the rights of the owners of the company. Partnership, a business owned by two or more individuals. Prepaid expenses, an asset resulting from the prepayment of the future expense as such as insurance or rent. Proprietorship, a business owned by one individual. Retained earnings, net income retained in the corporation. Retained earnings statement, a summary of changes in the retained earnings in the corporation for a specific period of time, such as a month or a year. Revenue, increase in the assets from selling products or services to customers. Service, a type of business that provides service rather than products to the customers. Statement of cash flows, a summary of cash receipts and cash payments for a specific period of time, such as a month or a year. Stockholders, investors who purchase stock in corporation. Stockholders' equity, right of owners of the corporation. Unit of measure concept, a concept of accounting requiring that economic data be recorded in dollars. Value chain, the way a business adds value for its customers by purchasing inputs into. Hope this video was useful for you. Looking forward to see you in my next video.